Hello everyone, and welcome to our strategic management video case analysis of Coca-Cola Bottling Company Consolidated. We hope you find this video beneficial. Coca-Cola Bottling Company Consolidated has determined a strategy is needed to rebrand its company as a beverage company and not simply a soda company. In this presentation, we will discuss a company overview, discuss the strategy needed to rebrand the company, external environment analysis, internal environment analysis, a financial analysis amongst all the financial statements, strategic concerns amongst the company, and recommendations by our group to help Coca-Cola Bottling Company Consolidated achieve their strategy. Coca-Cola Bottling Company is the largest independent bottler of Coca-Cola products in the United States. On their website, they state, "Our purpose is to honor God, serve others, pursue excellence, and grow profitability." Coca-Cola Bottling Company has been in business for over 115 years, has more than 300 brands and flavors, and it distributes to over 65 million consumers. Coca-Cola Bottling Company has 13 manufacturing facilities and 80 distribution centers, with its corporate headquarters located in Charlotte, North Carolina. Now, let's discuss the rebranding strategy. Coca-Cola Bottling Company wants consumers to think of them as a beverage company and not only as a soft drink company. They have to address and change the opinions of many consumers who only think of them as a sugary soda company. And the goal is to improve the consumer impression of the brand, which includes healthy alternatives to traditional sugar-based soda, and to gain market share from these health-conscious consumers. The external environment analysis shows that society labels the brand as unhealthy, and with the rise in health-conscious consumers, the Coca-Cola Bottling Company has had to expand its product line. Consumers are also worried about overall calorie count as well as the ingredients listed within the beverages. Major trends show that soda consumption is declining, and according to survey results published in Obesity, 60.7% of children and 50% of adults drink a sugary beverage on any given day in 2014. This is down from just under 80% of children and just under 62% of adults in 2003. Coca-Cola also has to deal with the government regulations when it comes to the nutrition labels and ingredients listed in their products. Now, let's look at the actions they've taken to address the external environment they're currently faced with. Coca-Cola Bottling Company has acquired and added many healthy beverages to their portfolio. These include tea, energy drinks, water, and dairy products. Over half of their current product offerings now contain no sugar. They've also changed packaging to include smaller cans and bottles, which is driven by the millennials who demand these particular options. They've also educated consumers that moderation is key to fighting obesity and that lower calorie alternatives such as diet drinks can help with this issue. To help illustrate the many product offerings and categories that Coca-Cola now offers, you can see here that they have their trademarked Coca-Cola brands and Diet Cokes, but along with those you see the energy drinks, the sports drinks, juices, teas, sparkling waters, and other vitamin waters that add to their healthy alternatives to just being a soda bottling company. Now, let's take a look at the internal environment. First, Coca-Cola Bottling Company Consolidated currently sells more than 900 products. Coca-Cola brand is known globally and is among one of the most valuable brands in the world. Along with this, challenges come in production with their current facilities limited on space and the cost to package the smaller portions as has been demanded by consumers. As of right now, they only produce about 50% of their product line because of old buildings not designed for such an expanded product line. As we begin the financial analysis of the Coke company, let's first look at their share price. As of November 17th, 2017, they were at $202 a share, and their total revenue for fiscal year 2016 was almost $3.2 billion. This is up 37% from the previous year. Their cost of revenue is about $1.9 billion a year. It's up roughly 38% from the previous year, which coincides with the total revenue. Gross profit has also increased. They saw profits of $1.2 billion, which was an increase of $300 million over the prior year. And in finishing up with the net income, which is one of the most important numbers to look at, they actually finished with $50 million in net income, which was a decline of $9 million from the previous year. That's something that we'll need to take a deeper look into as we progress through the financial analysis of Coca-Cola Bottling Company Consolidated. Now, let's take a look at some key financial information from the balance sheet for Coca-Cola Bottling Company Consolidated. Cash and equivalents are at about $21 million. This is down $34 million from the previous year. Total current assets are around $593 million. This is up $158 million over previous year. Total assets, almost $2.5 billion. They're up about $602 million from the previous year. Total current liabilities are $457 million. This is up about $131 million over the previous year. Total liabilities sit right near $2.2 billion. This is up substantially from the previous year of about $568 million more than they were. So total liabilities and equity again equal to be almost $2.5 billion, up about $602 million over the previous year. A large part of the asset growth and increase in liabilities is due to the acquisitions of bottlers across the United States, and in taking on more bottlers and adding to their manufacturing facilities, they've also increased the debt in order to acquire these companies. That explains a lot of this growth of assets and again the increase in liabilities for Coca-Cola Company Bottling. Now, to finish up on the financial statements, we'll look at the cash flow for Coca-Cola Bottling Company Consolidated. They had capital expenditures of $172 million. They had net cash flows from financing of $256 million. And you can see that they had a net cash flow of negative almost $34 million for 2016 fiscal year. A great way to analyze the financial statements and really determine how well a company is doing is to look at some of their financial ratios. We're going to look at the current ratio, the acid test ratio, working capital, accounts receivable turnover, inventory turnover, and profit margin for the company. First, let's take a look at their current ratio. We've taken the $593 million in total current assets, and we've divided that by the $457 million current liabilities, and this gives us 1.296 current ratio. In 2016, the current ratio was 1.331. Although anything above 1 is generally good, the decrease in this ratio should raise some flags and be addressed moving forward. Now, let's look at the acid test ratio. With $21 million in cash or cash equivalents and $364 million in receivables, divided by current liabilities of $457 million, we end up with a ratio of 0.84. This means that if Coke had to pay off all their liabilities within a year, they would not be able to do so with the most liquid of assets, and they could struggle trying to liquidate some of the other assets to come out on top. This could be considered a weakness and should be addressed by the company. 2016, the acid test ratio was a 0.91, So again, we've seen a drop in one of their key ratios. Coca-Cola Bottling Company Consolidated will again need to look into what caused this drop, but generally it's caused by higher than usual liabilities with lower assets. Now, working capital. This is a strong area for the company. In 2017, they've shown $135 million of working capital. That's over $108 million in 2016. So again, as stated, this puts them in a good position when it comes to their liabilities and debts and shows strength in working capital. Accounts receivable turnover, it shows how quickly the business is able to collect and replace their outstanding receivables. In this case, Coca-Cola Bottling Company improved their accounts receivable turnover to 40.15 days, which is below their company average. This also should be viewed as a strength for them. Inventory turnover, it shows us how often the business is able to sell and replace the merchandise inventory. Coca-Cola Bottling Company Consolidated had a cost of goods sold for the 3 months ending in September 2017 was $752 million. Coca-Cola Bottling Company Consolidated's total inventories for the quarter ending in September 2017 was $196 million. So when you look at Coca-Cola Bottling Company Consolidated's inventory turnover for the quarter ending in June 2017, it was 3.84. The Coca-Cola Bottling Company Consolidated sold and replaced their inventory 3.96 times during the year. This is a strength. And finally, to look at their profit margin on sales, they showed that Coca-Cola Bottling Company Consolidated had a profit margin of around 0.39 or 39%, which means that every dollar Coca-Cola Bottling Company Consolidated gets to keep 39 cents. The previous year was also 39, but the year before was 40. Although 1 cent isn't much, the trend is declining and should be addressed for future endeavors. Causes for the drop in profit usually are higher supplier costs, intense competition, or in the case of Coca-Cola Bottling Company Consolidated, it could be a loss of profit through acquisition and taking on new manufacturing facilities. So when we look at strategic concerns for the company, first we'll take a look at the financials. Coca-Cola Bottling Company Consolidated needs to increase cash and equivalents to address the inability to satisfy debts within 1 year based on current financials. They need to monitor the slight drop in profit margin as they've seen over the past 3 years. And they also need to be sure they're capitalizing on the acquisition of new territory and manufacturing facilities as they grow the company. Rebranding, again, is the main point and goal of Coca-Cola Bottling Company. And in order to do this, they're going to have to change the perceived image and perception of consumers regarding Coca-Cola and it being categorized as a soda company. Based on our analysis of Coca-Cola Bottling Company's Consolidated's financials, their strategy and goal of rebranding, we believe that financially they need to continue to work on improving efficiency with production to reduce liabilities costs within the supply chain. They also need to modernize and increase space of manufacturing facilities to accommodate production and the expanded production lines they now have. They also need to continue to acquire bottlers to widen the footprint of territory in order to gain strategic markets that can add to the bottom line and profits of the company. They also need to take a look at some of the lower selling items and eliminate these low revenue producing beverages from the product line, which in turn could also help with production and the space needed to accommodate such a large product line. And the second part of our recommendations in regards to rebranding, we believe that placing vending machines with no sugar drinks in them and labeled as healthy alternatives in key locations that have a desire for that type of beverage as opposed to sodas could be a great benefit for the company and would also help in rebranding to their desired market. They could also create more ads promoting the healthy drinks, utilize recognizable figures such as athletes, actors, or even doctors that can endorse the products and show that Coca-Cola is not all about sugary soft drinks, but is committed to providing beverages in all categories. They could also do community work and sponsor events relating to healthy living and promote the healthy alternatives at those events. They can also provide specials or promotions on healthy drinks to persuade and encourage consumers to try them. This concludes our video case analysis for Coca-Cola Bottling Company Consolidated. And on behalf of the team, we would like to thank you for viewing this video.